Welcome back, everyone, to the Deep Dive. Ready for another deep dive?
Always.
Awesome. Well, today we're going to be looking at this Federal Reserve decision to hold interest rates steady. We're going to be digging into their press release and the implementation note they put out and trying to really understand what it means for businesses and finance.
Yeah, it's a big one.
Yeah.
And it's interesting to see how the Federal Reserve kind of reacts to what's going on in the economy, right? Trying to keep things stable without letting inflation, get out of control.
Yeah. So, right off the bat, in this January 29th press release, they start off by saying that, the economy is growing at a solid pace,
Yeah.
low unemployment. So on the surface, things seem, pretty good.
Mm-hmm.
But then there's that word, inflation,
Right.
somewhat elevated. And, that's something that's been a big concern for businesses, especially when it comes to planning and pricing their products, in this environment. What do you think?
Yeah, I mean, it's tricky, right? Because on the one hand, you want to keep prices competitive. But on the other hand, you've got to cover your own rising costs. So finding that right balance is key. And I think that's a huge part of why the Fed decided to hold rates steady.
Yeah.
They're essentially saying, hey, we're going to kind of keep things as they are for now, just to give businesses a little more predictability.
Mm-hmm. It's not time to hit the gas just yet.
Exactly.
Yeah. And they even say it right in the press release, the risks to achieving their employment and inflation goals are roughly in balance.
Yeah.
What does that even mean? What are the practical implications of that?
So it basically means the Fed is walking this tightrope.
Yeah.
They want to see jobs, they want to see growth, but they also know if they push too hard, inflation could get even worse. So businesses need to be prepared for, potential volatility as the Fed tries to find that sweet spot.
For sure. Okay, so let's dig into that implementation note they put out, because this is where they really lay out how they're managing these interest rates.
Yeah.
So they mentioned that the interest rate on reserve balances stays at 4.4%. And this directly impacts banks. But how does this actually trickle down to the rest of us, in our everyday lives?
So think of it like this. This interest rate, it's kind of a benchmark for the whole financial system. So when this rate is higher, it usually means borrowing costs go up for businesses, consumers, the whole nine yards.
Mm-hmm.
Loans, credit cards, everything gets more expensive. So
Yeah.
by keeping it steady, the Fed's basically trying to avoid any big sudden changes that could rock the boat, Keep things predictable, keep things stable.
Okay, yeah, makes sense. So they're holding rates steady, but then they also mentioned all these overnight repurchase agreements and overnight reverse repurchase agreements.
Yeah, those are always fun to try to explain.
Yeah, honestly, those sound super confusing to me. Can you break those down, in simple terms?
Sure. So basically, think of them as these super fine-tuning mechanisms.
Mm.
They give the Fed a really tight grip on these short-term interest rates. They're constantly tweaking the rates on these agreements, adjusting the limits, really carefully managing how money flows through the whole financial system. It's like they're constantly making these tiny adjustments to keep the engine running smooth,
Yeah.
Making sure nothing seizes up.
Okay, that's a good analogy. All right, so holding rates steady, carefully managing the money supply with these overnight operations. But they're also continuing to reduce their holdings of Treasury securities, agency debt, all those agency mortgage-backed securities.
Yeah.
And that seems like a pretty big move, right?
It is. That's what we call quantitative tightening. And basically, they're trying to shrink the amount of money floating around in the economy, to fight that inflation. So by selling off these assets, the Fed pulls money out of circulation. Less money sloshing around, the less it can drive up prices.
So they're trying to cool the economy down from a few different angles then.
Right.
Holding rates steady, shrinking the money supply. This is going to have some pretty major effects on the financial markets though, right?
Oh, absolutely. We're talking potential ripple effects across the board. And one of the areas we're watching really closely right now is bond yields. So as the Fed shrinks their holdings, bond prices usually drop. And when that happens, bond yields go up. And that can make it more expensive for businesses, even governments, to borrow money, which can really impact their plans and investments.
Yeah, and it's not just bond yields we got to think about too.
Yeah.
This quantitative tightening can really shake things up in the markets. We're talking increased volatility.
Oh, for sure.
When the Fed makes these big moves, it creates a lot of uncertainty. And you know what happens then?
Yeah, everyone gets a little jittery.
Exactly. People start second-guessing things. Asset prices can swing all over the place.
Yeah.
Okay, so lots to watch out for there. But at the end of the day, the Fed keeps saying, maximum employment, bringing inflation down to that 2% objective. What are they going to be looking at to decide what to do next? I mean, business has got to be ready to react, right?
Oh, absolutely. The next few months are going to be crucial. The Fed's going to have their eyes glued to every new economic data point that comes out.
Mm-hmm.
Inflation reports, employment numbers, consumer spending, you name it. Those are the things they're going to be analyzing to figure out if the economy's on track or if they need to make some adjustments.
So they're constantly taking the economy's temperature and then adjusting the treatment plan as they go.
Pretty much.
Okay, so let's get specific. What data points should businesses be paying extra close attention to?
Well, we already touched on inflation. That's going to be huge. They're going to be watching reports like the Consumer Price Index, the Personal Consumption Expenditures Price Index.
Those are the big ones.
Yeah, they want to see inflation moving towards that 2% target.
Mm-hmm.
Anything that looks like it's veering off course could mean they got to step in and, maybe change course a little.
So if inflation starts heating up again faster than they want, they might have to raise rates sooner than we all thought.
It's definitely on the table. And then on the flip side, if inflation starts cooling down faster than they expect, well, they might hold rates steady for longer.
Okay.
Maybe even consider lowering rates to keep the economy humming along.
It's like a constant balancing act.
It really is.
Well,
they're trying to walk that line between keeping inflation in check and not slamming the brakes on economic growth.
you mentioned employment numbers, too. What are they hoping to see in those reports?
So that monthly jobs report, it's a really good snapshot of how the labor market's doing, how many jobs were created, how many were lost. What's the overall unemployment rate? A strong labor market with steady job growth, that's a really good sign for the economy. But if things start to slow down, there are, fewer jobs being created, unemployment ticking up, that could be a sign of trouble brewing.
Okay, so we've got inflation, we've got employment, and then you also mentioned consumer spending. What's so important about that from the Fed's perspective?
Well, think about it. Consumer spending makes up a huge chunk of the economy.
Yeah, that's true.
So it's a major indicator of how things are really going. The Fed's going to be looking at retail sales, consumer confidence surveys, trying to get a sense of how much people are spending and how they feel about the economy.
Yeah.
If spending starts to drop off, it could mean people are getting nervous about the future.
Makes sense. It's all connected, isn't it? Like the Fed's actions affect how confident people feel, and then that affects how much they spend, and then that circles back and affects what the Fed decides to do next.
It's a feedback loop for sure. But let's zoom out for a second and think about what all this means for businesses on the ground. How can they use all this info to make good decisions when there's so much uncertainty in the air?
Yeah, that's the million-dollar question.
Right. Well, I think the most important thing is to stay informed.
Okay.
You got to keep your finger on the pulse of the economy. Keep an eye on those indicators we've been talking about. Understand how changes in inflation, employment, consumer spending could impact your particular industry.
So it's not just about reacting to what the Fed does. It's about being proactive, thinking ahead about what might be coming down the pike.
Exactly. And, different businesses are going to have to adapt in different ways.
Right, for sure.
For example, let's say you're a business and you see inflation keeps climbing.
Okay.
Well, you might need to rethink your pricing strategy. You got to protect your profit margins, right?
Yeah, for sure.
Or maybe you're seeing signs that consumer spending's about to slow down. Well, you might want to scale back on inventory or hold off on big investments.
So being flexible, being able to adjust quickly, that's going to be crucial for businesses to survive and thrive.
Absolutely. And what about businesses that are thinking about taking on new debt?
Yeah, good point. Like maybe they're looking to expand or make a big investment. How should they be thinking about interest rates right now?
That's a really important question. The fact that the Fed's holding rates steady does create an opportunity.
Okay.
Borrowing costs are relatively predictable right now. So if you're thinking about taking on debt, this could be a good time to lock in a rate. But you got to be smart about it. Do your homework. Make sure your business plan can handle it if interest rates change down the line.
Don't just jump in without thinking it through.
Right, because who knows what the Fed's going to do next. This isn't necessarily the end of the story.
Yeah, exactly. So do your due diligence. Make sure you can handle whatever comes next.
And this is where having a good relationship with a financial advisor or a lender can really pay off. They can help you navigate this whole landscape, figure out the best way to manage debt, explore different financing options.
Okay, that's great advice. It sounds like communication and collaboration are going to be super important for businesses to get through this next chapter.
No doubt about it.
But let's not forget, it's not just businesses that are affected by what the Fed does.
Right.
Individuals are feeling the impact too. So shouldn't they be paying attention to these same economic indicators?
Absolutely. The Fed's decisions have ripple effects that touch every corner of the economy. So it's important for everyone to understand what's going on and how it might affect their own personal finances.
Okay, so let's shift gears for a minute and talk about what this all means for individuals. What are some key takeaways for them, especially when it comes to things like savings, investments, planning for the future?
Well, I think a lot of people are probably wondering right now, what does this mean for my savings account? If rates are staying low, does that mean their money's just sitting there, not really growing?
Yeah, that's a real concern. Like with interest rates holding steady at these levels, what can people actually do to protect their savings from inflation?
Yeah, it's a good question. With traditional savings accounts and CDs, the returns you're getting might not keep up with inflation. So you might actually be losing purchasing power over time.
That's scary.
It is. So this might be a good time to look into other investment options, things that could offer higher returns.
Okay, like what?
Well, there are things like index funds, real estate, even starting your own business. But of course, anything with higher potential return usually comes with higher risk too. So you got to do your research, weigh your options carefully.
So, like always, diversification is key. Don't put all your eggs in one basket.
Exactly. Spread that risk around. Okay, now let's talk about debt. A lot of folks are carrying mortgages, student loans, credit card debt. What does this all mean for them?
Yeah, what should they be thinking about right now?
Well, if you've got a fixed rate loan like most mortgages, you're in good shape. Your monthly payments won't change even if the Fed decides to raise rates later on.
Okay, that's good news.
It is. But if you've got variable rate debt, like some credit cards or student loans, well, those interest rates could go up.
So, might be a good idea to look into paying that down as quickly as possible.
Couldn't hurt. And for anyone thinking about making a big purchase that needs financing a car, a house, anything like that, this stable interest rate period could be a good time to lock in a rate. But again, think it through. Consider your whole financial picture before jumping in.
Always weigh those costs and benefits. Okay, let's talk stock market. What do all these interest rate moves mean for investors? Time to change strategies.
Well, got to remember, the stock market's influenced by a lot of things. It's not just interest rates. You've got corporate earnings, global events, how investors are feeling overall. It all plays a role. But in general, when interest rates are climbing, bonds start to look more appealing compared to stocks.
Weigh that.
Well, bonds offer a fixed return. So in a shaky market, that can feel more attractive, like a safe haven.
So we can see some people pulling money out of stocks, putting it into bonds for a bit more stability.
Could happen, yeah. But the important thing is to look at your own situation. Make sure your investment strategy matches your goals, your risk tolerance, how long you're planning to invest.
Right, don't panic and make a rash decision based on one headline.
Exactly. Stay calm, think long term. Don't get swept up in the short term ups and downs.
Great advice. Well, we've covered a ton of ground today. From the Fed's decision to hold rates steady, the impact on businesses, personal finances, the whole economy. Any final words of wisdom for our listeners as they try to make sense of it all?
I think the key takeaway here is knowledge is power. The more you understand how the economy works, how the Fed's moves affect you, the better decisions you can make about your money and your future. So stay curious, stay informed, and don't be afraid to ask questions.
Couldn't agree more. The more we understand, the better we can all navigate this crazy world. And hey, the conversation doesn't end here. Keep learning, keep asking those tough questions. Thanks for joining us on The Deep Dive.